Hi, welcome back to the channel. Hope everybody's doing well. I've got 3 UK stocks lined up which I'll give a brief overview on and why I think that these companies look like good buys. If you enjoyed the video and get some value out of it, please drop it a like and subscribe to the channel. The first company I have here is DS Smith, who are a leading producer of corrugated cardboard and recycled paper industrial packaging. They deal with all sorts of packaging that we see in our everyday lives, that we see in the shelves, and also heavily associated with e-commerce. DS Smith operates across various regions such as the UK, France, Iberia, Germany, Italy and the US, as well as other areas. On a 1 year basis, DS Smith are down 32% to a price of around £2.90 per share. This provides a market cap of just under 4 billion and a PE ratio of about 14, as well as an above average dividend yield of over 5%. DS Smith have been heavily affected by the global stop-start economy over the last few years, with lockdowns changing spending habits and company working models. Revenue has been declining since 2019 for these reasons, but this company does have pricing power and able to pass on higher input costs onto customers to keep revenue and earnings pretty stable. Using simply Wall Street to get a gauge on analysts' future earnings, it has 4 analysts covering this, and they have earnings improving from here on out to 2025, with revenue estimations of above 7 billion. This could well happen, as DS Smith are beneficiaries of 2 ongoing waves. Firstly, the importance of sustainable, recycled packaging, and also the growing market that is e-commerce. A quick look through the balance sheet using the latest information available has the company with total assets of just under 10 billion, cash equivalents of 819 million, total liabilities are at 5.6 billion, which is pretty unchanged in recent years, with total debt sitting at 1.5 billion, also the lowest in recent years, so pretty robust and healthy looking balance sheet to me. On to some of the key takeaways from its recent earnings. DS Smith reported a 21% year-on-year improvement in reported revenues to 7.24 billion, partly driven by price increases which pushed up operating profits by 23% to 616 million and pre-tax profits ahead by 64% to 378 million. Earnings per share has also grown 53% and the hiked dividend up 24% to 15 pence. Net debt was cut to 1.48 billion from 1.79 billion and free cash flow improved to 519 million from 486 million thanks to increased profitability and a positive working capital inflow of 215 million, more than offsetting the 100 million increase in capital expenditure to 431 million. The new financial year has started well, building on the momentum from the previous year. Whilst there remains considerable uncertainty about the overall economic environment, our expectations remain unchanged. The strong customer demand reinforces our confidence to invest in the business, with capital expenditure expected to further increase in the current year. If you do enjoy dividends, then we have recently declared dividends and the annual dividend history here. This year's final dividend will be paid in November with an ex-dividend date on the 6th of October. The annual history of the dividend on a 5-year basis has been quite sporadic due to the effects of COVID. A payment ranging between 14 and 16 pence in most years seems to be what to expect. DS Smith's earnings presentation reflect the positive information we've just went over, 5.4% year-on-year volume growth and all other financial metrics up apart from net debt, which has been reduced. Earlier I mentioned about the pricing power DS Smith has, and this is the evidence here. Costs were around 1.2 billion, made up with raw materials of 720 million, 297 million for energy and 190 million with other costs, but through sales pricing they achieved positive earnings. DS Smith have also provided a positive outlook into full year 23 despite challenging market conditions, with current expectations of about 2 to 4% in volume growth. TipRanks has 6 analysts on this stock, giving it a strong buy rating. 5 have it as a buy, 1 hold, with an average price target of £4.43, which would give you 53% to the upside at current levels. Stock number 2 is IG Group. IG Group Holdings are a UK based global financial technology company. The company develops technology platforms, products and exchanges for a range of trading and investment opportunities around the world. The company's segments include the UK, EU, Europe, the Middle East and Africa, non-EU, Australia, Singapore, Japan and the US. It has a huge array of different services it offers, but to sum it up in a sentence, it offers access to trading in shares, indices, commodities across a global platform. The share price is down 16% with a share price of about £7, which provides a market cap of 3 billion, PE ratio of 7.2 and a huge dividend of about 6%. Revenue and earnings have been growing since 2019 with 3 successive years of fantastic growth. This growth is expected to be continuous out to 2024 where revenue is to exceed 1 billion. Onto the balance sheet, total assets of 2.8 billion with 872 million in cash, total liabilities of 1 billion, But when we see that total debt is only 312 million, which can easily be covered by the current cash position, really emphasises how solid this balance sheet really is. The final dividend for the year is still to be announced, but the annual dividend over the last 4 years has been flat at 43.2 pence per share, but it does yield over 6% and is well covered, which could appeal to income-focused investors. Going back to the latest update from March, where IG Group said that their third quarter revenues had been the highest of the year, driven by continued momentum across its businesses as it looks to deliver on its strategy to expand and diversify. Revenues were up 13% to 257.2 million, as a 4% increase in OTC leveraged derivatives revenue to 219.3 million more than offset a 54% crash in stock trading and investments revenue to 6.6 million. While a jump in exchange traded derivatives from 1.7 million in 2021 to 31.3 million in 2022 was responsible for most of the outperformance. The firm also said that it's seen an all-time high in the number of active clients at 292,000, up from just under 221,000 at the same time last year. First trades in the quarter of 25,600 were down 32% on the prior year, but continued to be significantly higher than the pre-pandemic quarterly average of 13,200. Looking forward, IG Group anticipated that the full year revenues would modestly exceed the current market expectations and said that it remains well positioned for the future. Again, this information is slightly outdated due to the upcoming earnings release, but we'll see how the performance was from the interim results from January. Net trading revenue and profit before tax has been grown in an impressive fashion from the half year 2019 to the first half year of full year 2022. IG Group have a diverse revenue pool, with the UK and Ireland making up the highest proportion, where 41% of revenue is generated from. 38% of revenue was generated by the growing Asian Pacific region, with Japan now contributing a larger proportion of the overall portfolio. Japan has been a real standout performer in the terms of the growth, where since the first half of 2019 through to the first half of full year 2022 it had a staggering 400% growth rate, and it will be really interesting to see how this fares in the upcoming year. Guidance provided is a target growth rate of about 5 to 7% per annum in their core markets over the medium term. Within the high potential markets, targets are 25 to 30% revenue growth per annum over the medium term, with tastytrade at the higher end of the range. Full year 2022 operating costs are expected to increase 7%, and the effective tax rate expected to be about 19% for the full year, to be in line with UK corporation tax increases. TipRanks only has one analyst on this one, but they are super bullish with a buy rating and an average price target of £12.10, which would give you a whopping 72% upside to current levels. Stock number 3 is Softcat. Softcat are a UK-based provider of IT infrastructure products and services. The principal activity of the company is that of an IT reseller and IT infrastructure provider to corporate and public sector markets. It helps commercial and public sector organisations design, procure, implement and manage their digital infrastructure. They provide cybersecurity, digital workspaces and cloud computing solutions. The share price over the last year is down close to 25% to £13.49, which gives it a market cap of about 2.7 billion and a PE ratio of 26.4, as well as a dividend yield of about 1.6%. Recent years have shown growth on both top and bottom lines, which is fantastic to see revenue and profits growing together. And analysts don't think that this will stop here, with forecasts out to 2024 showing that revenue could be over 1.5 billion, which would be great for this company and the share price if this can be pulled off. The balance sheet shows total assets of 551 million, with cash at the bank of about 74 million, total liabilities of 388 million, with only 5.14 million on the balance sheet as long-term debt. Softcat does pay a dividend, which has been growing at a really impressive rate over the last few years. In 2017, a payment of 22.50 pence has been paid out, where it has now grown to over 41.3 pence, which is great news for long-term shareholders within Softcat. Earnings won't be due out for another few months, but we can still check through results released in January. The profits beat expectations, where first half gross profits were up 11.7% at 150.2 million, while operating profits were 12.4% higher at 64.1 million. Earnings per share were also up 12.4% at 26.2 pence. Interim revenues grew 22.6% to 770.9 million, and a gross invoiced income shot up 33% to 1.15 billion. The company highlighted that it delivered strong growth across all key income and profit measures, despite very strong comparatives for the prior period. They did provide an update in May, saying that they see the full year operating profit slightly ahead of expectations after a strong third quarter. The company said it delivered double-digit year-on-year growth in revenue, gross profit and operating profit for the 3 months to April 30th across all the technology segments, reflecting strong and stable customer demand, and that the supply chain situation remains challenging but consistent with the first half of the year. When we see some of the companies that Softcat has listed as vendors, it's some of the most recognisable and reputable names that you would ever want to be associated with. Microsoft, Apple, Intel, HP and Samsung, all huge companies as well as others. Softcat's growth within its customer base and gross profit per customer has been growing in a really healthy fashion from 2015 out to the most recent January 2022, with the high growth looking to slow slightly as the company matures. TipRanks only has one analyst in this one too, with a hold rate and an average price target of £17, which would give about 26% upside from current levels. Softcat seems to me to be a suitable candidate for investors looking for dividend growth over time with pretty decent capital gains at the same time. And that'll bring this month's picks to an end. Thanks very much for watching, and I'll catch you all in the next video. Cheers.